Okay, so today we're looking at expanding on what we did previously. Specifically, I want us to look at the liquidity and get into more detail in terms of understanding what is the liquidity of the company, what is that we're looking for. And we're going to do some comments on the ratios, do some calculations. But what is more important, I want you to understand what is liquidity. I want you to understand how do you comment, how do you interpret the liquidity of the company, which ratios you need to look at. We did speak about that liquidity in a high level. Like I think in the previous class, I did show that liquidity, it means it is the ability of a company to pay off its immediate short-term debt. That's what we were checking previously, and we did look at the ratios that falls under liquidity. We spoke about current ratio, we spoke about acid test ratio. We spoke about the net current assets, which is a net working capital. We're going to look at these ratios today. Turnover rate of stock. We sometimes call this a stock turnover rate. Debtors collection period. And then we have creditors payment period. And then we have average period of stock on hand. These are the ratios that we have under the liquidity. So now for today, I want us to understand, what does current ratio mean? What is the meaning of a current ratio? We need to get an understanding of current ratio. We need to get an understanding of the acid test ratio and what is the difference between the two. Net current assets, net working capital, it is an important ratio, but they don't usually ask about it in grade 12. But it's something that we need to know. Turnover rate of stock, very important. Debtors collection period, very important. Creditors payment period, this one is very important. And then we have average period of stock on hand, very important as well. So that's what we're going to focus on today when we're talking about the liquidity. And then this side, I have an example where we will be, example 1, where we'll be looking at some calculations with financial statements here, and we're going to be doing calculations from these financial statements. But for today, for now, let us understand liquidity first. Okay, when we spoke about liquidity before, we said liquidity refers to the availability of resources to meet short-term cash requirements by timing cash inflows and outflows, right? The availability of resources, it means that do we have enough resources for us to be able to meet our short-term cash requirements? So whatever that we need to pay, in cash, do we have enough resources for us to cover those requirements? That is liquidity. If you don't have enough resources, the reason why they're referring these to resources is because we're not looking exactly at the cash that we have in the bank. We can also use our debtors. We can also use our inventory. Inventory is not cash, but we can call it a resource because that is an asset. That is an economic resource. Same with accounts receivable or debtors or trade receivables. Those are resources as well that we can convert into cash, and then we meet our short-term cash requirements. And then number 3, we have bank under current assets. So we are looking at that availability of those resources to meet the short-term cash requirements by timing cash inflows and outflows. Okay, any firm should be able to meet its short-term commitments. That is, current assets should cover current liability. Yes, the aim of liquidity, this financial indicator or this category of financial indicators, which is liquidity, it actually tells us that we need to have current assets that are greater than current liabilities all the time, right? This is the area of analysis when we talk about liquidity. All the time, our current assets must exceed our current liabilities. There must be no time where we're going to have current liabilities less than greater than current assets. Okay, so now under liquidity, we have ratios, 6 of them that we're going to look at. All these ones that we spoke about here, 1, 2, 3, 4, 5, 6, 7. There's actually 7 that we're going to talk about. But as I said, that this one is not that important, so I don't want us to focus on it more. But that is the first one we're going to start with. Net current assets, also known as net working capital. Here, I just need to get a positive net current asset. It has to be positive because net current assets, we're talking about current assets minus current liabilities. So it means now, all the time, if I have 100,000 as what is my current asset, if I have 100,000 as my current asset, I need to have 60,000 rand as what is my current liabilities. All the time. If I have 100,000 current assets, I need to have 60,000 current liabilities. If these are current assets, okay? And then here, if I have current liabilities, which means it has to be like this. Then my net current asset, it's going to be these two. So if I say here, I'm going to have what? I'm going to have net current asset or net working capital. Net current asset or working capital. Net working capital. It has to be positive all the time. It has to be positive all the time. So that will indicate that the company is in a good liquidity position. If it is always positive, it will indicate that the company is in a good liquidity position. I said here it's 100,000. Okay, so we're going to have a net which is 40,000 rands. That means that we're in a good liquidity position. But as soon as we having 120 here, so this company is not in a good liquidity position. The company is insolvent, actually. That's what it means here. The company, it is insolvent. It cannot meet its short-term cash requirements. It cannot meet its short-term cash requirements. Now, what they're saying here, current assets is equal to inventories plus trade receivable plus cash and cash equivalents. We know about that. We know about this very well, what current asset is made up of. 3 things that are included there: inventories, trade and other receivables, and with cash and cash equivalents. Now, current liabilities, we having trade and other payables plus the bank overdraft. Can you see there? Trade and other payables plus the bank overdraft, which means, do I need SARS income tax there? Do I need shoulders for dividends there? It's something that we have to look at as time goes on. We'll see whether we need those things or not. But current liability is talking about trade and other payables plus bank overdraft. In order to control working capital, the retailer must ensure that enough liquid funds are available to settle current debt, which means now our current assets must always be greater than the current liabilities. Stock is sold at a reasonable prices and within a reasonable period of time to prevent cash being tied up unnecessarily in stock. You see now, Kinelwe, what is more important here is that whenever we're having a stock, we have to be sure that this stock, we will be able to sell it within a short space of time. We will be able to convert it into cash within a short space of time. If it can take me 2 to 3 days to convert my stock into cash, that is very good for me. It means I will be able to meet my short-term obligations. But if I am unable to convert my trading stock into cash, here I have current assets of 100,000. That's what we said there. They say this current asset is made up of what? Inventory. They say there's inventory here of 40,000 rands, and then we have trade receivables. Let me just say trade and other receivables Our trade in other receivables, let's say maybe we have 50,000 there, or maybe let's say we have 30,000. And then now we have bank, which is the cash in the bank, that is cash and cash. Okay. Cash and cash equivalents, we have also 30,000 rands, which end up giving me how much? 100,000 rands. Okay. So these are my current assets. This trading stock, which is an inventory of 40,000 rands, I should be able to convert it into cash, right? That's what they're saying here. Stock is sold at a reasonable prices, which means I don't have to overcharge people. I don't have to overcharge my customers on this trading stock, because it will be difficult for me. It will be very difficult for me to convert this into cash. Hello, Kinelo, you're back now. I can see your message. No problem. I'm sorry about that. Can you hear me on your side? Can you hear me on your side, Kinelo?
Yes, sir. Sorry, the electricity tripped.
No problem, no problem, no problem. I understand. I'm sorry about that. So I was explaining here that if these 100,000, which is our current asset, is made up of inventory, trading other receivables, and what? And cash and cash equivalents of 30,000. So what this is actually saying, this point here, to say stock is sold at a reasonable prices and within a reasonable period of time to prevent cash being tied up unnecessarily in stock. So it means now, if it takes long, remember there is cash here. This is actually a stock that should be converted into cash. If we are able to sell it, which means we're going to have cash after selling this stock. Trading other receivables, also, it doesn't have to take time for us to convert this into cash. We must be able to collect our money from customers, from our debtors. We don't have to struggle to convert this into cash as well. If we are struggling to convert these two into cash, most likely we will not be able to cover our short-term obligations, because we cannot only use the cash in the bank. We also need to convert these two into cash, inventory and trade and other receivables, so that cash is not tied up into inventory unnecessarily, and it is not tied up into our trade and other receivables. So that is actually net current assets. Net current asset, we have to be careful all the time. It has to be positive. So it should be 100,000 minus 60,000, and then we're getting the 40,000 rand. That is net current asset. Nothing much that is needed from there. Most likely they won't even ask you about it in a test. But current ratio, this one is very important. Current ratio is very important. Definitely, it is going to be in the exam. So what they're saying about current ratio: a high current ratio suggests a strong liquidity position, right? A high current ratio suggests a strong liquidity position. Okay. So now, what is a current ratio? Current ratio says that equal to current asset is to current liabilities. Okay. Current liabilities. Okay. We actually trying to do what here? We're actually trying to compare We're actually trying to compare our current assets is to current liabilities. That's what we're trying to compare here. Current ratio, current assets is to current liabilities. So we want to know how much of current assets we have and then how much of current liabilities we have. And also we want to know that our current assets can be able to help us to pay our current liabilities. That is the question that we're always asking ourselves. But there are some important details that we need to understand under current ratio. They're saying here, a current ratio suggests a strong liquidity position. An excessively high current ratio means that the firm has invested too much in current assets, which is also not good. We understand that current assets should be above our current liabilities, right? It has to be above so that we have a strong liquidity position. However, an excessively high current ratio means that the firm has invested too much in current assets, which is no longer a good thing as well. Now, they say many users apply a guideline of 2:1. That is the norm. Our current ratio should always be around 2:1, not far from this. To evaluate a firm's debt paying ability, however, there are certain limitations to using this guideline. Look, we have some limitations that we need to talk about. Trading stock is stated at a cost price, not at its realizable value. Therefore, current assets are understated. Nowadays, bridging finance is more easily accessible and is available almost immediately. Thus, short-term liquidity problems can be attended. Okay, let's talk about this norm of 2:1. This is our guideline. Our current ratio must be around 2:1 all the time. It can be a little bit less than this. It's still okay. It can be a little bit higher than this. It is still okay. But once it is excessively higher than 2.1, then it's a problem. Current assets to current liabilities, we're expecting at something like maybe 2.1. 2.1 is to 1, for example. Or 2.3 is to 1. That is the current ratio that I'm looking at. Maybe 1.9. 1.9 is to 1. 1.9 is closer to 2. It's still okay. But now, when it starts being like 0.2 is to 1, this is a problem now. This is a problem. Even if it's like 1.1 is to 1, it's a problem still, because although you are able to meet your short-term commitment here, but you're in a risky position here. Right? This is a risk for a business to have 1.1 is to 1. Or else, if I'm saying, let's say we have 6 is to 1, this is not right as well. 6 is to 1. I don't know what's happening now. Or maybe if I say 6.5 is to 1, then it's a problem. It means now we've invested excessively on our current assets. It is not advisable that we have a current ratio that is looking like this. No. It is not advisable that we have a current ratio that is looking like this. No. Okay. Okay. This is like more important, that our current ratio should always be something like 2:1, something like this. 2:1 or 2 point something. 2.3 is to 1 is still okay. 2.3 is to 1 is still okay. It must not be far from this one. Then now we're going to be dealing with how to comment. Let's look at the third one. Acid test ratio. Acid test ratio, then it is another financial indicator now. Acid test ratio, which is equal to current asset minus current, current assets minus inventory. Is to current liabilities. Okay. Now, in this situation, current assets minus inventory is to current liabilities. What are we trying to do here? We're trying to check if can we be able to meet our short-term obligation? Can we be able to meet our short-term obligations without relying on inventory? If we take out the inventory, can we still be able to pay our creditors? That's what we're checking. We should be able to, but let's go and look what is our note saying here, because we also have a norm here. This is the most stringent test for liquidity because it excludes stock, which is inventory, which is the most unpredictable item amongst the current assets. Yes. This ratio tests the ability of the business to settle its current debt under abnormal conditions when the business is experiencing a severe decline in sales and when firm does not depend too heavily on its inventory. Many users still apply 1:1 as a guideline. Calculating this ratio depends on the manner on which information is provided. Current assets minus inventories is to current liabilities. You see, there's a norm here that is expected, which is 1:1. That one is acceptable. 1:1, it is a norm that we can say it is acceptable because it means now you can still be able to meet your short-term obligations without relying on the inventory. If it's 1:1 is good because it means now without relying on inventory, you can still be able to pay your creditors. It's a good thing for the business. It is a good thing for the business. Okay. It is a good thing for the business. Now, there is another one. So the formula here is current asset minus inventories, or you can say trade and other receivables plus cash and cash equivalents, and then it's to current liabilities. So it's up to you. It's either you take the total, you subtract the stock, or you just add the two. Or you can just add the two amounts and then remove your trading stock. So that is something also that you can do as part of the calculation. Now, what is also more important, we must be able to comment on the financial indicator. We have to be able to comment on the financial indicator. I want us to look at that example one and try and see if we can be able to calculate one financial indicator, and then we comment on it and see how should we draft our comment, because that's what I'm more interested in. That's what is more important. We should be able to draft our comments. They are very, very important. Our comments, they are very, very important. So let's go. I want us to go quickly and see this example. So this is a Mandla Trading Company, general retailers. That's what they're saying here. They aim at a markup of 50% on cost sales on credit account for 60% of total sales. The following information was extracted from the accounting record on 28 February 2013, the end of the financial year. Now, we have income statement, we have balance sheet, and we have notes to the balance sheet. Okay. Now, I want us to do the current asset is to current liabilities. Okay. current asset is to current liabilities, which is the current ratio. I want us to calculate the current ratio. Okay. Our current ratio, we know that is equal to current asset is to current liabilities. Okay. Now, how much is our current asset? From the information that is provided to us, how much is our current asset here? If we look here with tangible asset, and then we have current assets. Our current assets, we have 323,000 in the current year, and then 254,400 in the previous year. So we're gonna have to do it in both years. Which means we're going to do 2013, and then we're going to do the 2014. Okay. We're gonna do 2013, and then we're going to do the 2012. Okay. 2012, 2013. Let's see if we can do it. Let's see if we can do it. Okay. So now, how much is my current asset? In 2012, I have 254,400. And then my current liabilities, I have inventories, trade and other receivable, cash, and then I have current liabilities, which is trade and other payables, and then bank overdraft, ordinary shareholders. Okay, that is equity. But if I'm looking at current assets, I have it there, and then I'm having what? I'm having the current liabilities. Okay, I'm having current assets, and then I'm having current liabilities there. So now, let's do the ratio for the previous year. 254,400. 254,400 is 2. How much is my current liabilities? 115,960. 115,960. Okay. Then now for 2013, we have 323,000 is to 145,500. 23,000 is to 145,500. Okay. Yes. So that's it. That is what we have. That's what we have. So now let's punch the calculator then, Kinelwe. We know that we always divide with the number on the right-hand side for a ratio.
For the one on the left, I got 2.1, 2.2 is to 1.
That is the 2012 one, eh?
Yeah.
Okay, what are we getting? 2012?
2.2 is to 1.
2.2 is to 1. Okay. Thank you. Then this one?
I'm getting 2.3 is to 1.
2.2 is to 1.
It's still 2.2.
Still
2 is to 1.
Is to 1. Still, ne? Nothing
Yeah.
much, nothing has changed. It is still 2.2 is to 1. Okay. In both years, it is below, it is like above the norm. Okay. Then now let's do the acid test ratio. Acid test ratio. Okay. And see if we can be able to do it. Our acid test ratio, we have a formula that says current assets minus inventory is to current liabilities. Okay. Now, I'm just gonna see if we can be able to get this one. Here as well, we're gonna calculate the 2012 and then we're going to calculate the 2013 as well. Okay. Gonna do the 2012 and then we're going to do the 2013. Okay, let's go and see. Current assets minus inventory. So we're going to have 254,400 minus 195,000 rand. That's what we're going to do. 254,400 minus 195,000 rand. Okay, let's go and see. So I'm going to say here 254 100 minus 195,000 rands, and then is 2. My current 115,960. 115,960. So this is actually, this is what's happening now. Sorry about that. So this is actually going to be my ratio. Okay. This is going to be my ratio. Then now, now moving on to 2013 now. Let's go and do the 2013 and see if we can do it, which is the current year. Which is the current year. Okay. 2013, I'm going to say 323,000 minus 250. 323,000 minus 250. 323,000 minus 250. Okay, 323,000 minus 250,000 rands. Okay, and then it's 145. 500. It still has to be the same. Okay. Then now, how much is our ratio that we're getting in 2012?
0.5 is to 1.
0.5 is to 1. Okay. So that is 2012. Okay. Then 2013.
0.5 is to 1.
0.5 is to 1. Okay. Still the same thing, nothing has changed, né? So
Yeah.
now, commenting on a ratio like this, we have these ratios, we have this current ratio, and then we have the current asset. Now, interpretation, which is more important. Obviously, they will not ask you to calculate the ratios in grade 12. Most likely, we're not doing that, né? Most likely we're not doing that. But what we do more is the interpretation. So now the first thing that when you commenting, we spoke about that. I think previously. When we're commenting, follow these steps when commenting on the financial indicators. We said consider what the question is asking you to analyze, e.g. liquidity. So that's what we're talking about here. Decide on the relevant financial indicators. Obviously, we know here we're talking on current ratio, asset test ratio. Name the financial indicators giving figures, ratios, and or percentages. Giving figures, ratios, and or percentages, okay? compare the current year's indicator with that of the previous year. Say whether it has increased or decreased. That is the first thing that we need to talk about. We need to compare the current year indicators with that of the previous year. This number 2, name the financial indicators giving figures or ratios. This one, you do it when you only talking about 1 year only. But if you're talking about 2 years, you go to number 3. That's where you're going to compare the current year's indicators with that of the previous year, say whether it has increased or decreased, and then if possible, provide a general comment. Then once you have stated that, you need to provide a comment on what is the what will be the consequences of the increase or of the decrease. Now let's talk about current ratio. Current ratio remained the same. It didn't increase, it didn't decrease, but it remained the same from previous year to the current year. It remained 2.2:1. Okay. So that's the first thing that we need to state. If it had increased, we're going to say that it has improved, or it has deteriorated or decreased whatsoever. But now in this situation, current ratio remained the same. Or we can say remained 2.2:1, right? From 2012 to 2013. From 2012 to 2013, right? That's all you say. You have to say nothing much. That's all you have to say here. That's all, nothing else that you need to say. Then now, what about the acid test ratio? Acid test ratio, it also remained the 0.5:1 from 2012 to 2013. Acid test ratio remained 0.5:1 from 2012 to 2013. Again, that's what you said for the acid test ratio. Remained current ratio remained 2.2:1. Okay. Now, in this situation, you have stated the trend. We call this a trend, right? We call this a trend where you're just stating whether it has improved or it has declined, or it has increased or it has decreased. We call it a trend, right? We call it a trend. Then, if possible, provide a general comment. Right? Now, can we say that the company is in a good liquidity position or not in this situation? Now we need to state, let's talk about current ratio first. Let's focus on the current ratio first. Does the current ratio indicate that the company will be able to meet short-term obligations or not?
It indicates that the company would be able to meet the short-term obligations.
Exactly, because our current assets exceed the current liabilities, right? Now, yes. even though it did not increase, right? Even though there is no improvement from previous year, even though there is no improvement on the current ratio, however, it indicates that the company will be able to meet the short-term obligations. Okay, so that's all we need to state now. We'll say although there is no improvement on the current ratio, it indicates that the company is able to meet its short-term obligations, okay? Of which we are happy. We are happy with this, right? We are happy with the current ratio. Can we say something about the norm? Can we say something about the norm here?
Yeah, it's above the norm, slightly above the norm.
Exactly. Current ratio is slightly above the norm. Okay. Current ratio is slightly above the norm in both years, right? In both years. Okay. Which is a good thing to state that. Obviously, you indicating here that you understand what is the norm, which is it has to be above the norm. If it's like this, it's in a good, it is likely above the norm and not excessively higher than the norm. But to say it's likely above the norm, it's okay. Because at the same time, you will say you're meaning that it is not excessively high, which is not allowed, right? Which is not allowed. Now, let's look at the acid test ratio. What does the acid test ratio indicate if it's like this? Without relying on inventory, can we still be able to meet our short-term obligations?
I'm not sure because it seems like you won't, but it's at the same time it is a norm.
It is a norm. What does the norm say for acid test ratio?
That it must be at 0.5, 50 cents to 1 rand.
Does it say that, Kinelwe? Let's go and check. Acid test ratio, what does the norm say?
Oh, 1:1.
So
That
is
makes
this
more
one,
sense.
so is this one in it according to the norm?
No, it's below the norm. And you won't be able to meet your short-term obligations.
Exactly, because it says I only have 50 cents for every 1 rand that I'm owing. I'm only having 50 cents to pay, which means I am 50 cents short. You see, I am 50 cents short. I am unable to meet my short-term obligations. I'm unable to meet my short-term obligations without relying on inventory. Without relying on inventory, I am unable to meet my short-term obligations. Right? So that's something that we need to state here. The company is unable to meet short-term obligations without relying, okay, let's say it like this, without relying on inventory. The company is unable to meet its short-term obligations, right? It is unable to meet short-term obligations. Okay? Again, acid test ratio is below the norm of 1:1. Acid test ratio is below the norm of 1:1. It is below because we have 0.5:1 there. 0.5:1. You see all these comments that you have stated here, probably each of them you're gonna get 2 marks, 2 marks, 2 marks, 2 marks, or 1, 1, 1, 1. It will depend on whether the question, how many marks is the question. Like if they allocate 4 marks here or 3 marks, obviously there will be no need for you to write all these comments. Né? But all of them, they are relevant, as you can see here. All of them, they are relevant. All of them, they are relevant. But now let's talk about the final comment. Let's talk about the final comment. Are we in a good liquidity position or not in this situation, considering the two ratios? Are we in a good liquidity position or not?
I'd say not.
Yes. Why are you saying that?
Can you please go up again?
Yes.
Based on both of the ratios, why are we, if we're in a good liquidity position or not?
Yes. Or if you want to break them down, maybe one of them indicates we are in a good, or the other one, what would you say? But in overall, is the company in a good liquidity position or not?
I'd
You
say
see what
overall,
happens? Yes.
overall it's a good liquidity position, but we need to be able to pay our our short-term debts without inventory.
That's very good. That's very good, Kenelo. We need to improve. We need to improve on our asset test ratio, right? Overall, our liquidity position is good because overall is current assets compared to current liabilities, which inventory is still part of current assets. We're still in a good position. Like the liquidity position of the company is good, right? The company is in a good liquidity position. And it should be able to meet its short-term obligations. It should be able to pay its short-term debt. However, improvement is required on the asset test ratio. We have to note that. Because we're in a risky position if we are unable to pay. What if we are unable to sell the stock and convert it into cash? We remove it from the picture. If we remove the trading stock from the picture, it means we are failing to pay our short-term debt. But with the inventory included there, we are able. So now the liquidity position of the company is good. However, we need to be careful on the asset test. When you start removing inventory, things go south. You see. So now we need to state that this company is in a good liquidity position, right? It's in a good liquidity position. However, okay, we can even state that, and it should be able to pay its short-term debt, right? And it should be able to pay or meet its short-term debt, right? However, improvement is required on the asset test ratio. It is required. On the asset test ratio, improvement is required. We cannot lie about that. This one is bad. It is bad. If it's like this, it's bad. So it is required. However, the liquidity position of the company is still good based on these two. So this is like, can you see how we draft our comments?
Yeah.
Yes. We just need to be obviously, when you're stating the trend, you're gonna quote figures there and amounts, even the years. Very important to tell us about the year, the trend from 2012 to 2013. It has improved, or it remained the same, or it declined. Those things are very important to state. And then you also carry on telling us what happened after that. Okay. And then now that was our asset test ratio. We also call it a quick ratio. Now, when it comes to a stock turnover rate or stock holding period, these two, we need to understand them. Both calculations serve the same purpose. Stock turnover rate. What is a stock turnover rate? We need to talk about this and understand what does stock turnover rate mean. Cost of sales over trading stock. Here I have formulas here, like on this document, where formulas of this. Go and see turnover rate of stock. There is it here. Cost of sales over average stocks, and that is times per year. So which means now the stock turnover rate, it is checking how fast is the stock moving on our shelves, right? And the aim of the business, we always want the stock to move fast, because if the stock is moving fast on our shelves, it means we're selling it more. And for you to improve, for us to improve on a asset test ratio that is like this, we need a high stock turnover rate that will indicate a fast moving stock. Okay, let's go back here. What is a stock turnover rate? So it says here, refers to the period between which stock is purchased and disposed of. This calculation allows the firm to, you see, refers to the period between which stock is purchased and is disposed of. So the stock turnover rate, it has to indicate that how many times we're replacing our stock, how many times we're replacing our stock in the shelves. So replacing it 5 times and replacing it 10 times in a year, the 10 times one is better. So we're always expecting to see a big number with this one. I'm always expecting to see a big number, because if you can see here that they're saying it is in times here, times per year, right? So which means now my stock turnover rate in the current year, if I see 10 times, next year I'm expecting 20 times, next year I'm expecting 30 times. It has to increase the number of times I am replacing my stock. That's what I'm expecting to see when it comes to a stock turnover rate. They're saying here, these calculations allows the firm to distinguish between the fast and slower selling items so that undertaking can allocate cash resources accordingly. To have enough stock at all times by replenishing timelessly, to prevent losses through shops, soiling and handling, to reduce expenses related to storage, insurance and salaries. But in all of these, we are expecting the stock to move fast in our shelves. I'm not expecting to have a stock that will stay for too long. The stock must come and it must go. I must replace it. I buy it today, tomorrow's finished, I replace it. Tomorrow's finished, I replace it. I need to replace it more. I need to replace it more. It means I'm in a good position, because it means I am selling my stock. Fast stock turnover leads to less cash being tied up in stock, which is a good thing. You see, fast stock turnover leads to less cash being tied up in stock. Need for less storage space, fewer staff to supervise, negligible losses through shop spoiling, higher turnover and greater profit. The more your stock is moving, it is an advantage for the business, because that's why you're going to make more sales, you're going to make more profit if your stock is moving. Even you, if you buy 100 sweets today, you want to go and sell them tomorrow at school. If all of them gets finished tomorrow, you're going to be happy and buy another one. it gets finished again, you are happy, you buy another one, it gets finished. That's what entrepreneurs want to see in their business. Take note that average stock turnover rate varies from firm to firm and also depends on the type of goods being sold. Grocery stores with significant perishable stocks tend to turn over stock rate very quickly. On the other hand, jewelry store tends to have a lower stock turnover rate. Yes, it depends on the type of stock that you are selling. It depends on the type of stock that we are selling, but a stock turnover rate, if we're talking about stock turnover rates, let me just say here, number 2, I'm just gonna make an example of this one. If our stock turnover rate is equal to, maybe let me say 2013, and then I say 2012 here. If my stock turnover rate in 2013 is 15 times, then in 2012, maybe it's 12 times. This is a good thing for the business. This is an improvement, right? This is an improvement because in 2012, I was replacing my stock 12 times, but now I am replacing it 15 times. It's a good thing for the business. This should always increase. The stock turnover rate should always increase, indicating that my stock is moving fast. It is easy for me to convert it into cash. When you have cash available, it's easy for you to meet your short-term obligations, because whenever you need money, it will be easy for you to convert your stock into cash and make money. That's what the stock turnover rate says. We are going to do the calculation on it, and then we'll see. Let's talk about stock holding period. It is a more direct approach to rate of stock turnover because it indicates the physical time in days for which stock is held, right? The stock holding period is a good indicator of determining timers replenishment, so that there is a consistent and regular flow to ensure proper rotation. Average stock times 365 over cost of sales. If trading stock is not given, then use inventories. You see about this one, stock holding period. This one is, I think it's calculated in days. The stock holding period of which enough stock is on hand, or period of stock on hand, stock holding period, it is in number of days. This one, I want this number of days to keep on decreasing all the time. I want turnover rate must increase, but stock holding period must decrease, because it means I am not keeping my stock in my shelves for too long. No one will ever want that. No one would ever want that. Let's talk about this one, stock holding period. Stock holding period, it means how many days I am keeping my stock in my shelves. How many days I am holding stock in my shelves. If you go to school, you sell your sweets, they don't buy them all, you come back with them. You go with them again the following day, they don't buy everything, you come back with them. You go again, they don't buy. It takes 5 days for you to sell 1 packet of sweets. That is a stock holding period for you. It's 5 days. 2013 stock holding period. For improvement, this one has to go down all the times. If I say 5 days here, then here is 10 days. This is an improvement, a big improvement. It has to be always like this. If the stock turnover rate is going up, stock holding period must go down, which means this is a good thing for the business. We're holding stock for 10 days in the previous year. In the current year, we're only holding it for 5 days. It means we are selling it more fast now than in the previous year, which is an advantage for the business. Okay, we will talk about the comments that we're gonna put here when we meet again. But for now, I'll keep everything here. Any questions on your side, Kinelo?
No.
Okay, thank you. Thank you for your time, Kinelo. I will see you again